The four most dangerous words in investing are "this time it's different." Right now, it really feels like it is. The economy is acting like someone who drank 3 energy drinks, took a sleeping pill, and still showed up to run a marathon. Nothing lines up. Stocks are going up, interest rates are still above 5%, inflation spiked to 9.1% not long ago, and unemployment is sitting near 3.7%. That combination shouldn't exist. In a normal cycle, high interest rates slow everything down. People spend less, companies borrow less, the economy cools. But that's not what we're seeing. So what the hell is going on? To understand this, you have to realize something. This isn't a normal cycle. This is what happens when you stack multiple economic shocks on top of each other. And we've seen pieces of this before, just never all at once. Go back to the 1970s. Inflation hit 14%, energy prices exploded, and economic growth stalled out. They called it stagflation. It was one of the worst environments for investors. Stocks didn't crash overnight, they just went nowhere, for almost a full decade. Imagine investing your money and watching it do absolutely nothing for 10 years. That's what high inflation does. It quietly eats everything. Now jump forward to 2008. Completely different crisis. Too much debt, too much leverage, and a housing market built on sand. Banks were packaging risky mortgages, selling them as safe, and levering them to the point where one crack broke everything. And that's exactly what happened. The system collapsed. So central banks stepped in. They dropped interest rates to zero, and they printed money on a scale we had never seen before. Trillions of dollars, injected directly into the financial system. And it worked. It stabilized markets, it saved the banks, and it kicked off one of the longest bull markets in history. But it also created a new problem. It made the entire system dependent on cheap money. For over a decade, money was basically free. Companies borrowed aggressively, investors took more risk, asset prices went up across the board. Stocks, real estate, everything. Then 2020 hit. And instead of easing slowly, policymakers went all in. Over $5 trillion was created in just months. Stimulus checks went directly to consumers. Businesses got emergency loans. The Federal Reserve started buying assets at a massive scale. Liquidity flooded the system like never before. And when you flood the system with money, prices go up. That's exactly what happened. Stocks surged, crypto exploded, housing prices went vertical. Everything became more expensive. Then came the consequence. Inflation hit 9.1% in 2022, the highest level in over 40 years. At that point, the Federal Reserve had no choice. They had to step in, and they had to move fast. Interest rates went from 0% to over 5% in about a year. That is one of the fastest tightening cycles in modern history. And historically, that kind of move breaks things. It breaks banks, it breaks housing markets, it breaks over-leveraged companies. Something usually snaps. But this time, nothing fully broke. At least, not yet. The economy kept moving. GDP is still growing. Unemployment is still low. Consumers are still spending money. And the stock market? It's hitting new highs. But if you look closer, it's not the whole market. It's a small group of companies doing most of the work, the so-called Magnificent Seven. These companies now make up over 30% of the entire S&P 500. That level of concentration is extremely rare. It means the market looks strong, even if most stocks aren't. And the valuations? Some of these companies are trading at 30, even 40 times earnings. That's expensive, historically expensive. At the same time, there are cracks forming under the surface. Credit card debt has just crossed $1 trillion. Auto loan delinquencies are rising. Commercial real estate is under pressure. And many property owners are struggling to refinance their loans at higher rates. So on the surface, things look strong, but underneath, pressure is building. And here's the part most people miss. The economy doesn't react instantly. It works on a delay. What we're seeing today is the result of decisions made 12 to 24 months ago. Those rate hikes, they haven't fully hit yet. Debt hasn't fully reset. Companies haven't fully rolled over their loans. and consumers, until recently, still had savings from the pandemic. But that's starting to change. Savings are coming down, debt is going up, and higher interest rates are slowly working their way through the system. It's like getting hit by a truck but only feeling it seconds later. That delay is where we are right now. So what's actually happening? We're in a transition phase. The old world of zero interest rates is over. Cheap money is gone. But the full impact of expensive money hasn't fully shown up yet. Markets are pricing in optimism. The economy is showing resilience. But the system itself is more fragile than it looks. And that creates a very strange environment. Because things can keep going up longer than anyone expects. That's how bubbles form. But at the same time, the risks are still there. And when something finally breaks, it tends to happen fast. That's the nature of cycles. They don't move in straight lines. They move in extremes. So what do you do in a situation like this? You don't go all in, and you don't panic. You stay flexible. You manage risk. You avoid blind optimism, and you avoid blind fear. Because the truth is, nobody knows exactly what happens next. Not the Fed, not the market, no one. And that's normal. Every major cycle feels confusing when you're living through it. It only makes sense in hindsight. And right now, we're still in the middle of the story. Not the beginning, not the end, just the part where things don't quite add up yet.